Disclaimer. This podcast is for FCA authorized financial advisors only and is not for retail clients. The views expressed in this content and all other content on this channel are those of the individual speaking and do not constitute financial advice or a recommendation to invest in any product, asset, or strategy, including those discussed in sponsored segments. This content is for educational purposes only. Always do your own research and consider all relevant risks before making any investment decisions.
Models they can try, but they can't predict human action. And they can't include all the risks that are out there. There's just too many of them. That you suddenly had everything going along tickety-boo and everyone was really positive about things, and then suddenly everything falls off a cliff. How do we get wealthier? It's not by having more noughts and ones on a computer. It's not by having more bits of paper with numbers on. It's by having more real stuff that actually improves people's lives. If you have a money that's gradually being debased, then the incentive for companies that are making stuff is to reduce the quality of that stuff so that the sticker shock, they don't have to put the price up too much. Do you want to live in a quality world, or do you want to live in a cheaper and low quality world? That's, I think, the decision that a lot of people are going to have to make. Eventually came down to then there was one client who was keen to take it forward, and then we were very pleased to get the green light to proceed, and then we actually implemented and bought the Bitcoin.
Morning, Sam. Welcome to the Bitcoin IFA podcast.
Good morning. Thanks, Dan. Good to be here.
How are you today?
I'm very well, thanks. Very well, thanks. It's a bit wet and miserable outside, but apart from that, good.
Welcome to autumn in the UK. Right. You've got a really interesting financial services story. Talk us through it.
Thank you. So I'm an actuary by background. So for those that don't know, maybe your audience will generally know actually, but for those that don't know, simplistically, I think of accountants as looking at the recent past and actuaries looking at the future. Of course, the one thing we know about looking at the future is that we're always wrong. Hopefully we're roughly right. And so it takes that's the mindset that I think you need to be a good actuary in whatever sphere that is. So that was going back, when did I start? 1998. I started my actuarial career. All very sort of standard. Got on the treadmill. Sort of went through the exams. Not particularly quick through the exams. I was more interested in doing the work, the practicalities, than the theory that was in the exams. But nevertheless, slowly was ticking them off over a period of time. Moved companies a couple of times. Was initially working on what we think of as on the pension side, which is looking at the liabilities of defined benefit pension schemes, particularly. And then later moved over to the investment side of those same defined benefit pension schemes. So on both sides, pension and investment, you need to understand the other side, but obviously you've got your specialities. So I found the investment side, for me personally, I just found it more interesting, more uncertain actually in some ways, more variety and less routine. So you had to think on your feet a little bit. Thinking outside the box was generally a positive. And so from there I joined, moved company again, and then ended up at Cartwright about 9 years ago. And Cartwright in those days, I pretty much started up the investment team here, and our focus was on these corporate defined benefit pension schemes. And over the last 9 years, we've grown the team and grown grown the different specialisms we've got within the team. We've also expanded the key client target areas that we're going for. So our historical defined benefit pension schemes very much still core, still looking to expand that, but we're also expanding into charities, own assets, helping to provide investment advice there, and also corporates themselves. There's a couple of other small areas as well, but those are the big three. And that takes me to where I am now.
That brings us up to date. Okay, well, thank you for that. That's a really interesting journey, and I love the actuary thing. So looking at the future, and the only certainty really is uncertainty,
Yes.
but you're trying to make it less opaque. Is that right?
You're trying to make your guess better than a random dart in the dartboard.
Okay, all right. Well, which is why IFAs, for example, buy all of the equities rather than just the Mag 7, for example. But there's a lot of stuff there that I'd like to touch on. So that working on both sides, the liabilities and the investments, thinking outside the box, looking at the future, trying to guess the future. Therefore, I assume trying to find hedges against certain outcomes. For example, if we were to move into an inflationary environment.
Yeah, and one of the big issues that our industry has, and by our industry, I suppose I'm broadly talking about the pensions and investment industry in the UK. One of the problems that I think we've got is that we're very good at building models, but the problem is that if you're very good at building models, then you tend to think, well, then I've captured everything. And the problem is with models, of course, they're not the real world. The real world is much more. Maybe we'll touch on sort of Austrian economics a little bit, but models can't. They can try, but they can't predict human action and how humans react to certain situations, and they can't include all the risks that are out there. There's just too many of them, and particularly when you get into, there is quite a lot of thought that's gone into tail risks. So that's sort of very extreme scenarios and what happens in those scenarios. There's been a lot of analysis in there, but it's still a model, and so it's still going to suffer from the same. In real life, it's not the same as a model. So I suppose part of this is trying to remember that what really matters is what happens in practice in real life. What matters less is what happens in a model in theory. And I think sometimes our industry gets the wrong way around, which is a shame, because then also they fall into the trap of, if I can make this model more complicated, then it will automatically be more accurate, which of course is a bit of a nonsense. But it's fun building models. I don't deny that, but we've just got to remember how they fit in with real life.
Yeah, I completely agree. I was actually going to ask if you have a real world example of that, where you've built a model and found that humans in aggregate then acted in a completely different way to the model.
There's examples in history, aren't there? So for example, going into the global financial crisis, a lot of banks and other investors measured risk based on this value at risk measure, and maybe set capital that they needed to hold against those risks based on that model. And that value at risk is a very particular type of model, and it's got lots of assumptions there about how different assets might move in those extreme scenarios. And actually the problem is that it normally looks at how those different assets will move in normal times, and of course in extreme times often a lot of assets can move in the same direction at the same time, and all that correlation goes to perfect correlation, and that diversification benefit you thought you were getting is no longer there. And so then if that suddenly spikes this risk measure, and then suddenly your capital goes up, and then it sort of has all these knock-on effects. So that's probably an example of how, if you over-rely on a model, then it might be fine for a long period of time, but then at some point it'll trip you up. People get complacent as well.
Yeah, completely agree. Complacent and greedy. We have a long track record of over leveraging, getting greedy, and then you're absolutely correct. Something breaks. When those margin calls start coming in, everything correlates to one, where people go grabbing for liquidity wherever they can get it.
But it's human reaction. So that greed and that fear, overreacting emotionally to a situation is human. So we don't want to sort of dismiss it, because then we're dismissing something about humans, but equally recognizing that it's there and trying to protect against it.
the human brain is not really wired to trade correctly, right? Because of emotion, right? So the second you bring in emotion to essentially objective models or objective trading, it gets very difficult, right? And that's one of the jobs of a financial advisor, or certainly a financial planner, is to essentially act as a proxy psychologist during very, very, very large drawdowns, and especially because risk happens fast. So when we can have a 15-year bear market from 2008, 12-year bear market, wherever it is, a couple of little bumps along the way, but we haven't really had a multi-year drawdown and then sideways move. But if we were to get one, the sharper and longer the up drive, the sharper and quicker we would expect the drawdown. Human emotion, as you say, is very much when that risk comes and it's happening fast. Human emotion is to step out of the way of risk, survive. Right, that's the human brain is wired to do that. Are they not able to build that into the models?
Well, that's be interesting. So, what levels of emotion will AI be able to have? I don't know the answer to that.
Yeah, I suppose. Yeah. Would you not be able to model different scenarios? People are 20% emotional up to 80% emotional.
20% panic.
Yeah.
Yeah.
Okay. You mentioned Austrian economics, and actually, let's actually touch on that. It's not something I have touched on within this podcast. I know a bit through the Bitcoin stuff. If you feel comfortable talking about it, and the difference between Austrian and Keynesian, and I can chip in where I know. But before we come on to that, because it's essentially a direct correlation, everyone's against Bitcoin until they're for it. What's your Bitcoin story? Hi, team. A quick interlude to ask, what if you could offer your clients Bitcoin exposure on a regulated investment platform? Because that's what my friends at P1 have done. They've created a discretionary model portfolio invested into companies with significant operations in digital assets, available within general investment accounts, ISAs, and pensions, and managed by award-winning investment professionals. With P1's digital assets portfolio, you can access a professionally managed portfolio of listed companies powering the digital asset economy, such as miners, blockchain infrastructure, payment services, and listed companies with Bitcoin treasury strategies. It's Bitcoin and digital asset exposure built for regulated advisors. It's diversified, actively managed, and with full transparency. P1 created the portfolio for advisors who see the long-term potential of Bitcoin and the digital asset economy, and who are starting to look at how best to facilitate exposure for their clients. It is packaged in a way that fits into an advisor's day-to-day investment advice process. So if you're an advisor who wants to offer digital asset exposure without the operational headaches, visit the URL in the show notes or use the QR code on screen. P1, bridging traditional finance and digital assets. Only available on the P1 platform and via regulated financial advisors. And the value of investments can fall as well as rise, and you may get back less than you originally invested. Now back to the show.
That's right. So, all right. So I suppose it goes back to my sort of. I'm sure there's times when I haven't been open-minded, but trying to be open-minded and going through the actual exam. So I've been about 10 years doing the exams and working in the industry. Generally all going fairly well. And then 2008 happened. And that's the thought that then went through my head was, yes, but according to the theory, this shouldn't have happened, or shouldn't have happened in this way. Something's not right. So there was something wrong there, and so I sort of dug into or tried to find out. Okay, what is it I'm missing?
Just to jump in there, what do you mean by the theory? What was incorrect versus the theory?
Well, that you suddenly had everything going on tickety-boo and everyone was really positive about things, and then suddenly everything falls off a cliff. And I'd read about Keynes and his animal spirits, but they never struck me as particularly plausible or credible, because why would you, unless you get a lion coming over the hill, what's the reason for people to suddenly panic? And the problem is, of course, that these animal instincts are in this economic sense, is that they just happen out of nowhere, and then suddenly there's a 20% panic or whatever the number is that we might try and fit in our models going forward, and then everyone gets scared, and then it's got the domino effect. But it doesn't say what the line is that's coming over the hill. It just says people get scared, and so that never struck me as very credible as a reason for economic panics, recessions, business cycle, etc. So digging around, I found sort of, I suppose this is now 2009, maybe 2010, sort of found the Austrian School of Economics, and they explained much better what the line is that's coming over the hill, just to go back to that analogy, and therefore why are people panicking or acting in a certain way. So it was a more complete, a more logical, a more sensible, credible explanation of what is actually going on in the real world. Now, it's still got, it's still, okay, it might be described in words rather than a formula. It's still a model of the world in that sense. So there are going to be things around the edges, but it seemed to get to the core of what the real problem is, and how business cycles happen in the first place. So for those that aren't aware, there'll be other people who can explain it much better than me, but roughly speaking, it's saying that, so you started with a neutral position, and then the central bank lowers interest rates, and maybe at the same time the banks are expanding the loans, the mortgages, the credit that they're issuing into the economy, so the money supply expands. And the problem there is that people, businessmen, individuals, people in the real economy are then making economic decisions based on all the prices that are around them. And so just after this money supply has increased, you have all the prices of, let's talk about in terms of building a house, right? All the tiles, the bricks, they haven't changed in price. They're still the same price they were a moment before, but suddenly money looks cheaper, and so you can afford. It looks like a more profitable project. It's one of the first things we learn in the actuarial world is discounting future cash flows, and you'll do that. Your watchers of this podcast will do something similar for their clients. But looking at cash flows into the future, if your discount rate, the investment return you're expecting into the future, essentially, is higher than the present value of those cash flows is lower, and vice versa. So when the central bank reduces the interest rate, that makes a project look more profitable than it would otherwise be. And therefore it's more likely to go ahead. But the problem, of course, is that just people haven't realised, the brick seller hasn't realised that there's more money sloshing around than there was before. And he'll then get more demand from these new projects for his bricks. And therefore he'll realise, hang on a minute, I'm selling out of bricks, so I haven't got any on the shelves. And why I must put up the prices. For whatever reason, he doesn't have to understand the reason. There's more demand than there is supply. And so we put up the prices of bricks to counterbalance it.
He'll probably find that, to use this example, he may even find that because he's going to his supplier of bricks, who's selling out even faster as well.
Yes, you're
so
right.
Then he's like, well, then, okay, they've started charging me more.
We've simplified it dramatically, but there's a whole supply chain going on. And of course, when I'm talking about bricks and houses, we've got a very complex economy with so many incredible supply chains. The pencil poem is worth looking at. It basically talks about how a pencil is made, and that no one person can make a pencil, but it's only through all these complex supply chains to do the graphite, the wood, the paint, the bevel, the rubber, to put it all together. Anyway, so that's a tangent. So you have the situation where the brick seller puts his price up because he realizes there's more demand for some reason than he's got supply of bricks, of real stuff, importantly. Okay, so then the person who's building the house says, hang on, I did my calculations based on the old price of bricks, not the new price of bricks. And so I'm going to have to, well, first of all, they may not notice for some time. They might think, well, it's just a fluctuation in the price or something, it'll be fine. But at some point, they're going to realise, particularly when you look at lots of different house builders, that there's not enough bricks out there to build the houses they thought there were. So essentially, that economic boom is the central bank tricking the people in the economy, businesses and individuals, that there's more real stuff, real resources in the economy than there actually is, and therefore they sort of act as though there's those resources in existence when they don't. When reality hits and there aren't as many bricks, there aren't as many resources, then they have to pare back, and then that leads to the recession. So the key thing there is that the boom is the artificial situation, and then the recession is unwinding the mistakes that happened during the boom. Whereas if you read the mainstream media, it's the opposite. A recession has happened, we don't know why, let's not think too hard about it, let's just essentially create an artificial boom to offset the recession. But of course then that makes the problem worse and worse and worse.
I think that's a really interesting key difference. You're absolutely right, which is Keynesian economics, easy for me to say, would say that essentially growth is driven by spending. So we want spending, but what it doesn't take into account, and you're absolutely right, and that's the key difference with Austrian economics, is there is essentially a fixed number of assets. Like, we slowly inflate them, but there's a fixed number of houses. There's a fixed number of gold, right? There's, very, very small inflation
over time. So in 10 years' time, we should have the ability to make more bricks than we do now, but it's a slow thing.
Exactly. But what we've done is flood the economy with so much money that everything becomes more expensive, because if you divide the number of houses by all the money, but you keep inflating the denominator, I think it is in that situation.
Yeah.
Then the price of the house has to go up. But one house still equals one house. The only difference is the money has been increased. Therefore, we're just allocated. If you stop thinking of it as money, it's just unit. We're just saying this house is now worth more unit because there's more units in the economy. But the overall production hasn't grown at the same rate as the unit supply, and so you're right, it creates that recession. Whereas Keynesian economics would say that recession is caused because people are no longer spending.
Yeah, and the big sort of elephant in the room with all that is, how do we get wealthier as just generally as a society? How do we raise the average, the wealth and living standards? It's by having more real stuff. It's not by having more noughts and ones on a computer. It's not by having more bits of paper with numbers on. It's by having more real stuff that actually improves people's lives. So what's the way to get more real stuff that improves people's lives? It's to save, invest, invest in machines that can create these real resources, these consumer goods, create them more efficiently, more cost effectively, use resources more efficiently, so less resources for the same output, that kind of thing. And that is, so first of all, that's the opposite of what generally happens, which is then everyone's like, why are we not productive? Why are we not as productive as we used to be? Well, there's an obvious reason, because you've just turned everything on its head and essentially incentivized being less productive. So that makes no sense.
Just to cut in there, Sam. Yeah. So, but we actually live in this weird dichotomy where some things are outpacing that, right? So the price of technology, a new MacBook has been £1,000 roughly. I think their base model is £1,000, and it's been £1,000 for like 10 years. So they have to have gotten way better at production, right? So in that Austrian economics model, they've invested in, whatever that is, supply chain better technology, better processing power, blah blah blah, blah, right? All that stuff, so that the value of the money has gone down, but the price of that asset, of that consumer good, has remained the same. Or, TVs have come down, right? So like, a flat screen TV 20 years ago was thousands of pounds, and you can now get one that's 100x better for 200 quid.
Yeah,
So certain goods prove
right.
that this is the case when there is that investment in increasing productivity, right? And if you also think, I always think of like a can of Coke or a bottle of Coke. Realistically, that hasn't grown in price as much as it should, right? I always remember that it was like 50p 20 years ago,
Right.
and now it's probably only a pound, maybe 80p in a shop, something like that. So clearly, Coca-Cola have gotten exceptionally good at making Coca-Cola and then delivering it to you in a shop, including with higher rates of VAT, like factoring that in, right? And it's only grown by 60%, whereas and it's more difficult to shrinkflate something like a 500 milliliter bottle of Coke. It's always been 500
How hard
milliliters.
is it to produce? I think that's the key
Hmm.
of it. So I would hope that every year, as people think of new ways of doing it, it gets cheaper and cheaper to make a can of Coke. Therefore, they can still be profitable whilst not rising the price. Interestingly, the price is still going up, but that's more to do with the quality of the money. However, if we look at things that are harder to produce, so ribeye steak is one of the sort of classic ones that's looked at, because it's hard work and takes a long time to rear a cow and all the things that go towards making it so you can go to the supermarket and buy your steak. And that price I haven't got the numbers on me, but that price has gone up a lot. And in fact, I was looking when I went last week. I mean, it might have been because they had a bit of a loss leader on the previous, but a rump steak in Sainsbury's has gone up by about 30% odd. Now, it might have been because they originally had it as an Aldi match price, and so it's a bit of a loss leader for them. So that might be an artificial increase, but it's no longer an Aldi match. They've given up on that by the looks of it. So,
I mean, I can actually give you a real world example of this. So I buy my meat from a place called NEP. Shout out for NEP, KNEPP. It's a rewilding project, right? So it was a farm for hundreds of years. And then the latest generation chap, I think he's in his 60s now, 30 years ago, just said, look, industrial farming is just ruining the land. So essentially what they did was just fence off the farm and then just left it alone. Just said, look, we're going to rewild it, right? Because the land will take care of itself. It will enrich the nutrients of the soil and blah, blah.
and do they have a cow on
So
there?
they've found
Fertilising
the latest or the closest to wild cattle. I don't know where they found them, but I don't think they're indigenous. And they've released all of those. They've got Tamworth pigs, which is the closest they could get to wild boar. They've got 2 or 3 types of deer. They've got storks, I think, now. So they've got the only nesting storks in the UK. They've had loads of butterflies. Like literally all of the animals have just gravitated there. I believe they just got sign off. So they were looking to, all the rivers have been artificially changed, right? So they were looking to bring back in the natural floodplain of the river. And the guy got a quote for hundreds of thousands, if not millions of pounds, right, to do this work, to sort of, bring the river back to its natural meandering course. And then someone just came in and went, if you release 2 beavers on here, they'll take care of that in 3 months. And he was like, okay. So it's very difficult to get a beaver license, but they managed to. Apparently it's very difficult to sex beavers. So what they thought they brought in a mating pair, they didn't. They brought in 2 males. I think one of them killed the other. Don't trust, verify that, but I don't think they got on. So they're, anyway, check out NEP. It's an amazing place to go walk. You can walk around it. One of the last ones I went on, we were walking through this field and we saw a pig, and it was almost like an industrial level of turning the soil over. So it was literally walking up and down. You could see where it had done it in straight lines that were at 90 degrees to the field, right? And it was just turning over the soil for the acorns and stuff, right? But they sell their meat. Now that meat is, as much as possible, that meat is antibiotic free. It's completely free roaming. It's had the best quality of life. It's grass-fed, grass-finished. It lives outdoors. There is no element of industrial farming in that. They're not able to guarantee that it's antibiotic-free, but they aim to be. Pork sells out in seconds, right? But their meat has doubled in price in the last 2 years. And because you cannot hide a single ingredient food like beef, pork, eggs. You can't hide the cost.
Yeah. Because hard to make, and it is what it is. You can't degrade it. You can't use shrinkflation or something like that to.
That was one of
grams of steak.
I don't know if you've ever read Ultra Processed People. It's a great book. So it's basically looking at like UPF, ultra processed food, and in that he outlines food companies' response to COVID, and it was essentially because all the supply lines got shut down. So then they had to really throw a lot of R&R into how do we make sure that this food is as imperishable as possible, right? This thing may need to sit in a warehouse for a year before it even hits the shelves because of something like COVID. And so their response was to essentially all of the perishable things in food are the nutritious things, right? So it is the animal-based products, it is the plant-based products. So they've just essentially removed all of them, right? He gave an example, a guy that used to work at a food company where someone came up with a new way of making tacos, like hard shell tacos. And essentially this guy came up with it and was like, this thing won't go off for 10 years. And everyone clapped. And you're like, then there's no food in it. There's nothing in there that's good for the human body, right? That's why McDonald's doesn't go off. It's why I always ask people to do this experiment. Put a small amount of margarine in a bowl and a small amount of butter in a bowl and just put it out in your kitchen. Because within 2 or 3 days, the butter is covered in flies and the margarine is untouched. Flies eat literal shit. And they won't eat margarine, which is essentially a solid form of like seed oils, vegetable oil, right? So, and it's Joe Bryan talks about this in his video that, one of the ways of creating that inflation is to basically just put more and more industrialized sludge into our food. Easy to produce, very easy to profit from, but the secondary and tertiary order effects are the obesity crisis, the health crisis, all of we're getting into a really based conversation.
I mean, but it's directly related, I think, to it's a natural consequence. That's a better way of putting it. It's a natural consequence of having a money that is losing value every year. So there is a, and I think this is a sort of a psychological or a reaction to a psychological sort of. Can't think what the word is, but if you have a money that's gradually being debased, then the incentive for companies that are making stuff is to reduce the quality of that stuff so that the sticker shock, they don't have to put the price up too much. We've seen it depends exactly on the product. If it can be seriously mass produced in a factory, then maybe actually they can produce it cheaper and cheaper than the money is losing value. But in most cases, they still have to put the prices up a bit. However, if you turn that on its head, you say, well, if you've got a money that gradually increases in value, which is maybe when we finally get to a Bitcoin standard, and Bitcoin isn't going to have the massive volatility and the massive price increases, that we've seen, and I expect we'll continue to see for some time yet, when it gets to a state where everyone's got it's massively liquid, the most liquid thing on the planet in terms of ease of buying and selling. It's going to be more gradual increases and much less volatility is the general expectation. So if you have that situation, then the incentive of companies making stuff is to try and justify keeping the price the same, because otherwise they're going to have to reduce the price. And so the way to do that is to make your product or service better and better quality. And so if you then compare those two worlds, one where everyone is trying to make things better and better, and one where everyone's just trying to make things, sort of cheaper and cheaper.
Well, yeah, or at least not more expensive.
Yeah, well, lower quality, so it doesn't have to get as expensive. Then think about the impact of that on two different worlds. And I think you could sort of put that in the context of Joe's highly recommended video, which you just referred to. What's the problem? That's sort of I can't remember if we touched on that specifically, but I think that's it sort of goes along with that. He's got two different worlds, two different hypothetical worlds. It's a great story because you're just changing one thing about them and seeing how things evolve and what the natural incentives are. So this thing about, do you want to live in a quality world, or do you want to live in a cheaper and low quality world? That's, I think, the decision that a lot of people are going to have to make. Well, they already effectively have made over the past, but there wasn't really a choice to move to a better system, whereas now there is. So people can choose to move to a system that isn't constantly undermining them. And yeah, it's going to take time, but when the majority of society, of the economy, has got on board with that idea, then there'll be a massive improvement in how things are going forward. And things, I'd fully expect the productivity puzzle to be solved as a result of that. But so
hopefully one day. There's a bunch of things that you've touched on. The first one is to say Joe Bryan's What's the Problem is always a link in the show notes. Please check that out. Either pause and watch it and come back. It's only 30 minutes. Or watch it after this. It's always in the show notes. Highly recommended for anyone that works in financial services. Highly recommended for anyone generally. Hey team, a very quick pause. If you're a financial advisor, wealth manager, or accountant, chances are your clients have already asked you about Bitcoin. And if they haven't, they soon will. Which is why I've created the Bitcoin IFA webinars. The webinars are designed to give you all of the information you need to confidently talk about Bitcoin with your clients. They're on demand, so you can watch them at a time that's suitable for you. They count as 90-minute structured CPD, and you'll get priority access to the Bitcoin IFA community. Head over to the bitcoinifa.com to book your webinar today. It takes less than 60 seconds. Again, that's the bitcoinifa.com to book. Now, back to the episode. You touched on the Bitcoin standard. We're going to come back to that one. So let's circle back a bit, because I asked you what was your Bitcoin journey, and then we just went on a massive tangent about Austrian economics, which is amazing. So then how? Actually, the last thing to say before that, you're absolutely correct that we didn't have the opportunity to do that previously, and I think it was Hayek that said in Austrian, he's an Austrian economist, that unfortunately because money has essentially been co-opted by governments, and there is the threat of violence essentially if you don't opt into their game, right? I can't pay my taxes in Bitcoin. I can't pay my taxes in euros or dollars. I have to pay my taxes in pounds, which is essentially being forced to cooperate in their game. And what I mean by violence is if I don't, I go to jail, right? In this country, in other countries, it could be worse. So Hayek said, we need some kind of sly, roundabout way to remove it from the hands of government. And this is, way pre-entered it. Yeah. So he was theoretically talking about something like Bitcoin without being able to see a practical way to do it. Hence why he was like, a sly roundabout way. Otherwise, he would have named something. But yeah, so let's come back to your Bitcoin journey.
Yeah. So I hit Austrian economics and sort of deep dived into that, and it was like a light bulb going off. And it's we've only scratched the surface. There's so much there, and that naturally leads, as it did a lot of people, to gold. So it's not a sly roundabout way, but it is a form of money that's hard to produce more of, and has been around for 5,000 years. And a lot of credit, I think, needs to go to gold for having lasted that period of time. But it's susceptible to abuse, basically. So if you can trick the market into thinking there's more supply than there is, then the price won't go up so much, and it won't get as much attention. Gold is typically known as the fire alarm of the financial system, but the trouble was, as soon as it was then known as the fire alarm of the financial system, then the central bank knew, well, actually, maybe we don't want the fire alarms going off, so maybe we need to do something about that. So there's various theories around how that might have been done, but so that was sort of 2012 sort of onwards, and I think I'd heard about Bitcoin once or twice, but then it's 2013 when I thought, okay, well, what is this? What is this thing? I just want to dabble a little bit to try and understand it. So that comes back to the point I mentioned earlier, that I'm more interested in how things work in practice rather than how they work in theory. Although the theory can be incredibly useful to understand how they work in practice, but they're not quite the full picture. So I've got to actually use it. So it was only dabbling, sadly. I obviously wish it had been a lot more, but just doing a Bitcoin transaction, or sending Bitcoin to myself, or something like that. Because there's no
2013.
Yeah, 2013. There was nowhere really. I mean, I think there were places you could buy it. I guess I never went on to Silk Road or anything like that. So it wasn't really about trying to buy stuff with it. It was about how does it work as a sort of as a technology. That's the bit that I was interested in. So I thought, that's interesting, but I sort of fell into the trap of thinking, well, it's fine, but there's all these other versions that seem to be starting to come out. Maybe one of them will be better, and so fine, okay. My career was getting particularly busy at that point in time, so I sort of parked that and forgot about it for a while, and then came back to it properly in 2021. So 2020, obviously, there was the big drawdown in the Bitcoin price, and then central banks were coming out and governments coming out with the furlough scheme in the UK and stuff, paying people's wages. Central bank came out, printed a lot of money, all this kind of stuff. But the trouble was, it was those kind of things and what's going on in financial markets that kept me very busy in the day job. So it was only really in 2021 I had time to breathe and to say, okay, look at that Bitcoin thing over there. That seems to have not died yet. And I think that was the thing that was probably the sort of key thing that then triggered me with deep diving again, was that I assumed it would have died. And of course, it had not died many times. Well, I mean, if you just look at it on when it completely crashed in price, maybe it hadn't died 3 or 4 times by that point. Of course, there have been lots more newspaper articles saying how it's dead. But that then led me to yes, as I say, to deep dive a bit more. And there are probably 2 key things that tipped me over the edge to feel that I'm always learning more. Don't want to ever claim that I understand everything, but that tipped me over the edge in being sufficiently confident from a personal point of view that this Bitcoin thing was a real thing, and was highly unlikely to die, and was also different to all the other cryptocurrencies, crypto assets, Web3, blockchain, all that stuff, right? Completely different to all of that, even though obviously uses some of the same technology underlying it. So 2 things were, one was reading the Bitcoin Standard, and that was really good for me because it essentially, bizarrely, there wasn't much new in there for me, because it took a lot of the building blocks that I already had, Austrian economics and gold, for example, and put them together and put them in the context of Bitcoin. So it was a very natural step for me. And the other one was dabbling with some NFTs and realizing what there's just nothing, there's no value there. So sort of going through that process. But again, the key point there is I had to try it out in practice rather than just think about NFTs in theory to really get my head around what they are, how they work, and that, okay, I don't mind some good art, that's fine. I've got a picture on the wall behind me, it's good art, but that's very different to NFTs being valuable, or indeed any of the alternative coins, as we might politely call them. I would go as far to say that there'll be some of those altcoins where they are, maybe there is some new technology, maybe there is a bit of value in tokenization, maybe there's a bit of value in, let's say, some of the way that these altcoins are thinking about a particular problem, but it's at the edges, and it should be compared with other technologies, sort of moving into a sort of portfolio construction sort of mindset. I would very much put over here, we're thinking about, we've got an allocation to money, so we've got government currencies, gold and Bitcoin, and that's the context in which we're thinking, how big should that allocation be? What should the split be between those three, if they're all in that basket? And then completely at the other end of the portfolio, you've got, okay, I want an exposure to technology companies. And you could make the argument that some of these altcoins should be included within that analysis. However, it's first of all from an implementation point of view, but also from sort of a due diligence point of view, buying a FTSE technology index which has however many companies in it, or buying the Nasdaq, or something which is an index which has got lots of different, going back to that diversification point earlier, you need lots of different companies if you're going to get diversification, because you don't know which technology company is going to win. And so in the context of those technology companies, I think it's incredibly difficult to justify from an institutional point of view. So I'm thinking what we mentioned, so corporate pension schemes, charities and companies themselves, it's incredibly difficult to justify any exposure whatsoever to altcoins, because the levels of disclosure, the way they're structured, their governance, all of those stuff. And that's after you've separated out which are serious technology improvements potentially and which are just pure scams, which is not always easy in the first place. So it's much easier just to say, just leave someone else, or park it, or just don't bother with that. And then you also look at the value of, okay, let's say a company comes, even if it's Google or Amazon or Tesla or someone, if they could come up with a new technology, what's the potential of that? If I put in £1 million for a client, what's the potential that it could get to? Right, look at that over there. And then you look over here at Bitcoin, and you look at, okay, what's the market for a better money? It's just two different worlds, two different universes, really, in terms of where the opportunity is, where the benefits are for the portfolio, the benefits for the economy, the benefits for society. It's just a completely different level. So that's why our focus as a firm is on Bitcoin only, because of those reasons.
Completely agree with what you've just said there. I highlight exactly the same in workshops and trainings. I like to use the metaphor, or a thought experiment, really. Go back 20 years. You couldn't have predicted the Mag 7, right? Even Buffett missed Google and Amazon at IPO. 2005, You couldn't have predicted that Google and Amazon were going to get as big as they were. Netflix was still posting people DVDs.
Yeah.
Meta didn't exist.
Yeah.
Apple pre-iPhone, great tech, but not really in the zeitgeist. And Microsoft hadn't switched to their subscription model yet, and they were big, but who knew? Tesla didn't exist. So 20 years ago, you couldn't have predicted the Mag 7. You could have predicted with a high level of certainty that gold was still going to be worth a lot of money.
Yeah.
And that's how I like to think of a win, because people will always ask, what about the other cryptos? Some of them will win. I have no idea which ones. They are continually improving on each other's tech. You're absolutely correct in that some of them can be very opaque in that they say that they've got utility, but I'm thinking of one in particular. I'm not going to name it because it has a very large following and community. But my understanding of their business model, they say that it has utility, but I don't see how it has any utility over and above Bitcoin, certainly not with the Lightning Network. And their business model seems to be announce a partnership, pump the price. So step 1, announce partnership. Step 2, price pumps. Step 3, founders dump on retail. Step 4, return to step 1.
Hey team, just a quick pause to say a huge thank you. You've given us your most precious assets, your time and your attention. And honestly, it means the world to us. If you've enjoyed this episode or you take value from these conversations, it would really mean a lot if you could like, comment, or subscribe. Those things really help the algorithm and they help the channel to grow. And if there's someone in your life who would take value from this, maybe a fellow advisor or someone just curious about Bitcoin, please send it their way. You never know what it might spark. Okay, back to the studio.
And this has been going on for a long time, but they have a very strong lobbying team and are trying to be involved with the rails of the tokenization of everything. So you're absolutely correct. Some of them will win, rightly or wrongly, but with a certain amount of certainty, 20 years from now, Bitcoin is going to be worth a lot of money. Not financial advice, do your own research. Some of the others, maybe. Who knows? So you mentioned that was the focus of your business right now. Let's touch on that, because I believe that you have allocated to Bitcoin within some of your pension funds, pension trusts. Is that correct?
Yes, we've got so if I'll just finish this bit because they provided a link. So by the end of 2021, I was confident on a personal level that I understood where the value was in Bitcoin, and that's fine, but that's not the same as saying that it's appropriate for our clients or we should be talking to them about it. So then rolled around February 2022, and Russia invaded Ukraine, and Russia had $300 billion worth of its foreign, I think they're all G7, foreign government bonds frozen. So in other words, Russia, a nation state, whatever you think about the nation state, a nation state which thought it owned $300 billion worth of value held in other governments' bonds, suddenly didn't. And so what that did is introduced explicitly counterparty risk back into government bonds. Now, they were always there. That counterparty risk was always there, but it brought it in explicitly.
Did that, just to interrupt you there, Sam, if I'm thinking about that correctly, then were those, let's say it was the G7, were the G7 just able to wipe out 300 billion of their own debt? Is that the way that works?
No, I don't think that's quite. I mean, they could, I suppose, but I think the way it works is that essentially, if let's say Russia has, it had $100 billion of US treasuries, effectively, because they're just pieces of paper, they are held on account by, now whether it's the US Treasury or the Fed, I don't know, or maybe it's the US banking system, but they're held on account outside of their jurisdiction. And therefore, if the US government says you can't have access to that money anymore, then whoever holds it, whichever one of those parties in the US holds those bonds, complies with what the US government diktat is, and therefore Russia loses its economic value. So those bonds still exist. I don't think it's. I don't think that act in itself is inflationary or deflationary, and particularly, bonds still exist, and the interest is still being accrued. It's just not being paid to Russia.
I see.
But
And then in theory, if they what's the word? If the end point on the bond, completely forgetting the word there, if that comes
maturity
due,
date, yeah.
the maturity date, exactly. So if it's a 10-year bond and it matured yesterday, they're also not paying back the underlying. So they weren't paying the coupon.
I think that's right. So I think they
but-
just.
yeah.
I mean, I haven't seen any analysis on it recently, but except that it moved from being frozen to being. I think they were trying to. EU, I think, was trying to pass legislation to essentially confiscate or direct it all to Ukraine or something, which is effectively the same thing.
So that obviously, that creates that counterparty risk. If they can do it to Russia, a sovereign state, I mean, in theory, there's nothing stopping them to doing it to all of the pension funds they owe that money to, right? I mean, there would be outrage,
I think that
but
would be. I think that would be. So it's obviously possible. I don't think that's likely. I think it's more likely they'll inflate that debt away. I think what it means more is that if you have big players, so nation states are obviously big players in the world, but there could be other. It could be a large company or something like that, or other organisation, where if they say something that a particular government doesn't like, then the precedent has now been set for that government to say, okay, that 10 million pounds of bonds that you've got about, well, you can't have it anymore, it's gone. And so it seems we're a long way from a company in the UK or the US suffering that, although it's obviously possible, explicitly possible now. But it's more likely that other nation states will be in line first. So it's happened to Russia. Could it happen to China? Well, if we went to war with China, they hold a lot of US treasuries. Why would the US still pay them? It'd be weird, wouldn't it, for them to pay them interest to then fund the war? Anyway. And then you've got other nation states. So maybe if a G7 government fell out with a Latin American government, or in the Middle East, or whatever it is, then suddenly now that precedent has been set. And so what that means is that those nation states in particular, but actually any significant investor, should be thinking a lot more about counterparty risk and whether it really wants to hold those government bonds. And what else it should be holding. And so the natural tendency would be, you might diversify the counterparty risk. You might say, okay, we're going to not have as many US treasuries, we're going to invest in US equities. That might sort of weaken the ability to confiscate those assets, but probably doesn't eliminate it. Whereas if they hold physical gold in a vault, then that does eliminate it. If they hold on-chain Bitcoin in their own custody, then that does eliminate it. And of course, gold and Bitcoin are. I mean, obviously, some people question whether Bitcoin is money or whether it will become money and all that kind of stuff. But in my mind, it's on its way to becoming money. Gold has been money for 5,000 years. The whole point of money is that you don't need it now; you need it later, and therefore you want to hold it in a way that it's not going to corrode or disintegrate or anything like that, and you can retain ownership, and then you can use the money later. That sort of store of value. So a form of money would seem to be a better option than an investment if the whole purpose is to retain value and have the ability to use it for trade at a later date. Anyway, so that led to that was February 22, and then there was I held 1 day later or 2 days later, I had a team meeting, held up a copy of the Bitcoin Standard and said, right, everyone needs to read this, please. Put it on expenses, but read it. And it was quite interesting then because I could see when it was coming through and who was reading. And it was a sort of drip approach. Initially, I think people thought I'd gone mad. And then, as I say, they were gradually reading it, and it's quite interesting how that has evolved. We've had a lot of conversations internally, and how those conversations have evolved over time. We still have some skepticism within the team, and I think that's healthy. But we've got a lot more, rather than just everyone thinking I'm crazy at the start 3 years ago, when it was 3.5 years ago. We've now got where they go, okay, I understand the premise. I don't quite understand this bit or that bit, or I'm not sure about this bit or that bit. That's fine, right? That's all part of the process, and it's important to have those constant challenges. But there's a general acceptance, I think, in the team now that Bitcoin is here to stay and has a role to play. And then we can really get into the details of, well, how should it be used? How should it be applied? What type of clients is it appropriate for? All these kind of questions. So really, that's particularly good. I'm particularly pleased from my point of view because they just talk about the practicalities.
It's really interesting there, Sam, that you brought up gold and Bitcoin, because you mentioned that gold in a vault couldn't act as money, but there's still threat there, right? So there's a confiscation threat as proved in 1933 and 1971 in the US. So even though in theory no one can take your gold because it's decentralized, if it becomes illegal to hold gold, then whichever party it is, company, investment trust, individual, they have to hand it into the government. Whereas obviously with Bitcoin, that's not happening, right? So if someone tells you to give you, if the government turned around and said, we're confiscating all your Bitcoin, you can jump on a plane and send them an email saying, bite me, to a non-extradition country, and your Bitcoin arrives with you. And that's actually something that, gold acted as that store of value because it was the best for 5,000 years, but Bitcoin has improved on that. I don't think we've ever actually touched on this on the podcast, how Bitcoin improves on gold in every element. So there's like 7 areas that you want money to have. So, you mentioned it needs to not be perishable. That's why we went with gold. Paper erodes, or, it needs to be fungible. Every piece needs to look like every other piece. I mean, even gold presents some problems there. You've got to assess the quality, make sure it's not just copper that's been gold plated. It needs to be portable, right? If you've got £1 million of gold in your pension, you want to move that from London to Manchester, that's going to cost you a pretty penny in security, unless you're prepared to just put it in a van and drive it yourself, but you probably don't want to do that.
There's still a cost,
and there's
your time.
Exactly. Yeah. Time, petrol, threat. And there's a few others. Look, we don't need to cover all of them, but I just wanted to highlight why gold basically improves on people can do their own research on that. And there's
a simple way of looking at that, which might sort of summarize it. So the way that we describe it is that there's 2 key attributes of money. The better they are, each of these, the better they are as a form of money. So one is, and this is based on the Bitcoin standard terminology as well, and so the sort of salability over space and salability over time. So how easy is it transfer value over time? So that's the sort of store of value point. Gold's been pretty good actually over that. Government currency, pretty rubbish. Bitcoin, better than both. And then you've got transferability over space. So if I want to buy something from someone in Australia and I send them the money, how easy and cheap is it to do that? Gold actually is pretty difficult, not impossible, but pretty difficult, particularly for large amounts. The sort of there was the French warship that went over to collect gold from in the 1960s, wasn't it? It's quite amusing. So, but government currency actually is pretty good, particularly for G7 currencies. It's actually pretty good at transferring over space, but Bitcoin is still better than both. So that's, and then all that fungibility and the stuff all flows into those 2 key categories.
Yep. Yeah, you succinctly and summarized it very, very well, much better than I was going to, and I'm going to steal that. So thank you. So let's come. So I think we're there, right? Unless we've missed something, I think we're there. So why Cartwright allocated a percentage to Bitcoin?
Yeah. So we can't, right. So the situation is we've got lots of clients, and they're all in different situations. And for each of those, we're helping them to build a portfolio of assets that meets their objectives. And to build that portfolio, we've got lots of different asset classes we can choose from, different ways of sort of, different equity. I don't mean, well, just different ways of getting equity exposure, different ways of getting bond exposure, property, liquids, and so on. Right. So you've got all these options. All we did was add Bitcoin to the list. So we didn't say that everyone should buy Bitcoin. We said you should consider Bitcoin when building your portfolio, when reviewing your portfolio. And for some clients, Bitcoin falls off the list pretty quick, right? So we have about 5,000 of these defined benefit pension schemes in the UK, and half of them are probably within 1 to maybe 3-4 years from being able to hand the whole lot over to an insurer. And therefore, their focus should be on, they don't need to take much investment risk. There's lots of other things for them to think about to make it a smooth journey from here to basically to pass it over to the insurer and then to wind that pension scheme up. The other half have got longer time horizons, so let's say 5 years plus. And therefore, they can then consider assets which have got more volatility associated with them. They can think more about the correlations between different type of risk assets and all these kind of things. So Bitcoin more naturally fits within that. But some of them will be, so it's the time horizon, investment time horizon, that's the critical factor there into that discussion. However, there are some of those where it looks at face value like they've got a long time horizon, but actually, let's say the sponsor employer's is very cash rich and might turn around in a moment's notice and chuck money in to effectively take that time horizon from 10 years to 1 year. Well, it's not really going to be appropriate to have volatile assets, super volatile assets within their portfolio. So sort of narrow it all down. A sort of back of the envelope calculation gets us to, of the 5,000 DB schemes in the UK, maybe 500 should have a Bitcoin allocation. And of course, the Bitcoin allocation that they have could be, it's going to be almost certainly small single digits, low single digits, 1 to 5%, let's say. It's going to be different for each of them, but that's it's sort of that level. So what we did is we applied that same logic to our client base. Now, the problem is we've been very successful in taking schemes, getting great deals from the insurers and taking those schemes to an insurer and getting them on that journey. So we've got a lot of schemes that have got not long enough time horizon. We do have some schemes that have a longer time horizon, but for whatever reason, maybe it's not appropriate for them. And we had those conversations with the it could have been a dozen schemes where we thought it was reasonable to have the conversation. And of course, you get a mixture of responses back. So you get those that dismiss it immediately out of hand, just when you say the word. And that's a real shame, because there were 1 or 2 schemes on that list where I think they could massively benefit. It was perfect from a pure investment point of view. It was like a perfect investment. But
and why do you think they're just immediately dismissing it and not being at least curious, asking about it? Like, is it regulation? Is it just ego? What do you think?
I don't think it was ego in these situations, but I think that will be the case elsewhere. I think it was, and one of the phrases that came up was, we want to focus only on traditional assets. Of course, then that raises the question of, well, how traditional? Does that mean we're only going to buy art and mansions?
Antiquities.
No, not that traditional, sort of somewhere in the
middle. But then, I mean, there's a stat I always like to show, right? Because people say, essentially what they're saying is it's not old enough, right? Traditional. So we don't want anything alternative or new. Bitcoin has traded 40% more hours than the NASDAQ. So the NASDAQ was launched in 1971, right? So it's really easy to remember. It's the same year we came off the gold standard, we launched the NASDAQ.
Okay.
Right. And because the NASDAQ only trades 8:30 till 4:30, whatever it is, Monday to Friday, Bitcoin trades 24/7, 365. So in 16 years, and I think it's actually 15 years when it actually started trading, like there was actually a price allocated to it in fiat. So in 15 years, it's traded 40% more hours. It's about 100,000 for the NASDAQ and about 140,000 for Bitcoin, which is obviously accelerating away from the NASDAQ faster and faster and faster because it trades 24/7. As a result of that, I believe the NASDAQ have said, I mean, I'm making that connection, by the way. Like, I think this is why the NASDAQ have done this, but they've announced that they will trade 24/7 Monday to Friday. So 24 hours a day from 8:30 Monday till 4:30 Friday from, I think, from next year, I think from 2026.
I think
Certainly
they
very
just
soon.
tied in with tokenization, wasn't it?
Yeah. Well, I think it was coming first. I'm not sure it was going to be at the same time. They are obviously also talking about tokenization. I have a friend that works on Wall Street who said that basically every young, ambitious, smart person is leaving Wall Street to go and start a Web 3.0 blockchain company. So tokenization is definitely coming.
Okay, that's a lot of brain power going into something with little value. But never mind. It'd be better if we wouldn't it be better if we built like more efficient machines and manufacturing and.
I mean, that's a larger question, isn't it? How much brain power for the good of humanity has been hoovered up by Wall Street? It's probably a shame. But so I interrupted you. Coming back to So what is a traditional asset? Because Bitcoin is
Yeah, that's right. Yeah, so that was one. That's one we spot, and I think it was done with sort of best intentions, but it's a shame when you sort of get that without even considering it further. It was sort of a high level at that point. There's those early first conversations where we think it's worth looking at Bitcoin in more detail. We're not saying you should definitely invest. We're saying you should think about it and do a bit of analysis. I think we even said we'd do the analysis for free because we were looking to obviously try and get traction and that kind of thing. And then importantly, think of how it would work within your specific portfolio. So not talk about not the generics. However, back of the envelope, we reckon this could increase your expected return from X to Y with maybe a slight increase in your portfolio volatility, and would also those are just sort of abstract numbers for a lot of people, quite understandably. Try and put it in the context of their particular situation. So you've got a time horizon of 10 years, maybe that reduces it to 8, right? So put it in real terms for them. And even then, we were just dismissed out of hand by most, I would say. There were then a small number that were okay. Well, let's have a look. Let's have a look at the analysis. And so then we produced a report which went through, explained a lot more about what Bitcoin is, so we could talk through and go through an education. Or we probably had a training session before then, sort of more general terms about what is money and therefore how does Bitcoin fit into that picture. And then they had this report on portfolio construction, and if you have a 2, 3, 4%, just to give some variety, allocation to Bitcoin, how does that affect the overall return, your overall objectives, your risk measures, and stuff like this, right? So it was basically treating Bitcoin in the same way that we treat any other asset. And we'd also think about things like liquidity of the portfolio and all that. So of course, Bitcoin is very liquid, much more liquid than some other pension scheme investors. So that should be a positive in some scenarios. So went through all of that, and that eventually came down to then there was one client that was keen to take it forward, and they're a great bunch. They really are. And one of the things that they are particularly good about is having an open mind and just trying to do things for the right reasons. And so they didn't approach it with preconceptions about, well, we should dismiss this out of hand because I read a newspaper article 10 years ago. It's like, okay, let's look at it. Let's prove it right or prove it wrong in the analysis. Bearing in mind it's only a model, obviously, so we talked around it. And it needed certain levels of sign-off. So the trustee group needed sign-off within themselves. And then they needed sign-off from the sponsoring employer and the parent employer as well. So it needs to go through various governance hurdles. And at each stage, there might have been a couple of questions back, and we helped with answering those. And that was all over the sort of first half and into the summer of 2024. And then we were very pleased to get the green light to proceed. And then we actually implemented and bought the Bitcoin in October 24. So it's getting on it's about 11 months since they invested. Now, we were a bit lucky with the timing. I certainly remember I was keen to push to get the allocation implemented before the US election. But even so, that could have gone either way. Maybe if Kamala Harris had won, then maybe Bitcoin would have tanked, or we just don't know. So you obviously need a bit of luck, but I think it's been helpful for them that it's done well. It's done well initially. Now, obviously, longer term, we expect it to continue to do very well. But it's nice to get a bit of a head start.
Wow. Chapeau and hats off to that one firm who have been open-minded and curious and, having a look at the models. And yeah, I mean, I was going to ask what the performance has been since you allocated, but I'm not going to ask you for anything like price predictions or anything like that. But in terms of the models and stuff, are you able to share? So what has it done in the last year? And then we all know that Bitcoin is a minimum 4-year hold, right? Minimum. The 200-week moving average of Bitcoin has never declined. I always say it's got a 100% hit rate if you hold for 200 weeks. I actually found new data the other day. It's not 100%. It's only 99.8%. So if you hold for a minimum of 200 weeks, you have historically made money. You've obviously held for a year.
I actually prefer that it's 99.8%, because to say something's 100% always makes me feel a little bit uncomfortable.
Yeah, absolutely. But forgive me, I round up. So yeah, talk us through what has performance been, and then are you able to extrapolate and share? You don't have to share actual numbers, but what does it look like? What does it look like within the model for them? And in general, what does it look like for the model with a 1, 2, 3, 4% allocation?
So the key bit of analysis. I mean, there was lots of various analysis, right? So there's various risk measures that are used in our world which people like to see, and that's fine. We can do all those. But actually, my favourite one was where we said, okay, what's your time horizon? Because they ultimately want to pass the scheme over to an insurer. The situation I mentioned earlier for virtually all of these DB schemes will be to do that at some point. And so we said, okay, we calculated the number. So it's about 10 years until you can afford to hand the scheme over to an insurer without any Bitcoin. Okay, so let's add 3% of Bitcoin in. And we did some different allocations just to look at the sensitivity, but 3% was the ultimate allocation. So if you do 3%, what does that do to the upside? What does it do to the downside? So the downside first is, let's say you put in 3% and it immediately goes to zero and never recovers, right? It's just dead. That 10-year time horizon goes to 10 years and 3 months. So it's obviously worse. It's got to be worse because you just lost some of your assets.
Yeah.
But, in the big scheme of things, it's only 3 months. If, on the other hand, we say it goes up in line with our best estimate assumptions, which I think at the time, I think we trimmed them slightly since, but I think we were assuming about 50% a year over a long period of time, of course. Then that 10 years goes to 8 years. So it doesn't. So there's some important points there. So one, it doesn't completely solve all your problems, but it makes a massive positive dent in it if things go as expected. And of course, that was based on a best guess of the future. Things can be better or worse than that. In fact, the one number it probably won't be is that best estimate, as you mentioned. All models are wrong. Some are useful, and so, but it helps, and also it shows the asymmetry of those returns. 3 months versus 8 years, and that is a great investment opportunity. So then we've
I've just quickly done the maths. Let's see if I got this right. The downside is a 2.5% increase. So it may take you 2.5% longer. The upside is it will take you 20% shorter. So it's a 10 to 1 essentially.
Yeah, it sounds about right. And I think we can, it's only a model, right? So we can argue, is it a 10 to 1? Is it a 20 to 1? Is it a 5 to 1? We can argue about it. The point is, it's not a 1 to 1. And therefore, it's highly likely for a scheme that can provide the volatility to have some kind of allocation to essentially get off zero with it.
And with the volatility, is there an element of rebalancing, or are you just letting the Bitcoin run and then what?
Because if it goes as we're all expecting, then it's going to end up 99.8% of the portfolio.
So I show the exact same data in my workshops and training, right? So I use nakamotoportfolio.com. I don't know if you know it.
Yeah, I've heard of that.
And I show the effects of a 1, 2, 5, and 10% allocation with and without annual rebalancing, right? Okay. With annual rebalancing, a 10% allocation to Bitcoin 10 years ago, your annual vol was 17%. And I used to work for one of the larger networks who are incredibly risk averse. So another way of putting that is incredibly return averse. But anyway, they do not like volatility, and all of their funds maxed out at 17% annual vol. So a 10% allocation to Bitcoin with annual rebalancing is a 10% vol. 10% without annual rebalancing, and you start looking at very high double digits. So I can't remember off the top of my head, but it's probably somewhere in the 50 to 70 range for annual vol. But that's because that 10% allocation to Bitcoin now represents like 98% of your portfolio, which, by the way, has gone 3,200x. Like, it's done insane returns. Yeah. But you're absolutely right. Like, you can easily see a 50 to 70% drawdown. So
and trustees are not going to sleep at night with that level of volatility or that size of allocation. So it's got to be trimmed in some way. Importantly, and I think this is maybe a difference between some of the people, between how institutions are thinking and how some individuals are watching this might think. So some individuals might think, well, yeah, but if Bitcoin's doing well, I just want to hold on to it forever. Okay, fine. That's your personal decision. But from an institutional point of view, there's 2 points. One, you're looking after other people's money, so that brings in other considerations. And secondly, you're managing a portfolio of assets, and therefore you need to be able to sleep at night. You need your stakeholders to be able to sleep at night. So if you start off with a 3% allocation and it goes to 6%, maybe that's still okay. Obviously, you can run some analysis to see if you're still comfortable with the numbers. If it goes to 15%, you're probably not happy. And indeed,
you're happy on the upside.
Well, you're happy on the upside.
But then you want to rebalance. You take some of that profit.
Yeah, exactly. You're happy that it's happened, but you're not happy with the level of risk that then implies, or level of volatility rather than risk that then implies. So some rebalancing is necessary in these scenarios, and therefore we need to think about, when we put 3% in place, we need to think about what if the price goes up, what if the price goes down, and that's already in the context of we've got a 10-year time horizon, right? So if the price goes down, the default is we just ride out volatility. Now, we might have a discussion and might decide to top it up. We might not. I think we'll probably have a discussion, but we may or may not top it up. But the default is just to ride through the volatility, the downward volatility, and then hopefully up later. If the price goes up, then we trim. And we trim at certain levels. And so we've got some essentially automatic triggers in place that when the price goes up by a certain amount, will trim the allocation a bit. And the starting logic is, well, the first thing we want to get is £1.5 million that went in, was a 3%. So we want to get our £1.5 million back to start with, and then psychologically we're playing with the house's money, and therefore we'll have another rethink at that point about where we set those trigger levels.
It's really interesting you say that. Pete Dunworth was on the pod. Do you know Pete?
Yeah, I mean not personally, but I know who he is.
Yeah. So he allocated 1 to 2% of his clients' portfolios to Bitcoin back in 2016. It's done 150x since then. I was actually watching a clip of it yesterday. I was posting a short from him, and he said it now represents 50% of their portfolio. So I think he's done some rebalancing, but it's it's a massive part of their portfolio still. But it's 5 to 10x his firm's revenues. I always say to advisors, if you know of another asset that you can put 1 to 2% in, that if it goes to 0, it's a bad day in the stock market, fine. But if it goes 100x, doubles or triples your client's portfolio, 5x's to 10x's your firm's revenues because of all the referrals you're going to get, go and do that. And tell me what it is, right? Tell me what the asset is, because I want to put some money into it. Yeah, Pete was saying that, so I think this is almost ingrained in human psychology. So Pete was saying the first thing that everyone wanted to do was get their original investment out. So put 1 to 2% of the portfolio into Bitcoin, went 10x or whatever, and they were like, right, get the original investment out, put it into whatever else, rebalance it into something else, and then it's house money, as you say. So it's interesting that at institutional level, all the way down to individual investors speaking to their advisor, there is that psychology of, we now can't lose.
Yeah, exactly. I mean, I think institutions would still struggle with 50%, but the psychology is still there.
Yeah,
we're still dealing with humans at the end of the day. It's just that they need to think a bit harder about some things and do things in the right way. I mean, so we were talking about 2 to 4% with them, and okay, you could argue it's in the middle, but they went for 3%. That's fine. Would we say 2 to 4% now? I mean, maybe. I mean, I think we would include 2 to 4%. I think what will increase that percentage is probably a couple of that top end. Is probably a couple of things. So one is, and we're starting to see some of that already, arguably. So one is better sort of regulatory environment, or at least a more certain regulatory environment. And I think that does put a lot of people off. Maybe we should touch on that a little bit more. And the other is, it's easier to have a higher percentage if you're only expecting drawdowns of 30% rather than 70 or 80%. So as that volatility dampens, that will probably help people get more comfortable with a higher percentage. Now, of course, when we get to that stage, you're going to need a higher percentage to actually make a meaningful difference on your portfolio. And that's the opportunity right now, is that you can put 2%, 3% in. And because of the massive asymmetry in the growth profile, can't go below 0, could 10x, then that's why now is the opportunity, which is not going to last forever. But people need to have the right sort of risk appetite and all the rest of it to do it.
Totally agree. I'm actually watching or listening to a podcast right now about Bitcoin's power law. So, the volatility both ways will diminish. But one thing that people often say is, I wish I'd got in earlier. But you were putting your money into something that was worth $200 and could have gone to 0 very easily. And I'm actually building a document right now for advisors about the 7 reasons or misconceptions about Bitcoin. And one of them is that you weren't wrong to not invest 10 years ago. You weren't. Like, we had the Mt. Gox thing. We've had FTX, which is 4 years ago now, 3 years ago. So even 3 years ago, it was an asset that had nefarious players in, uncertainty, a 60% drawdown. And it's not to say that any of that may not happen again in the future, but it was prudent at that time. Right? You spoke about it. You're managing other people's money. Yep. So you weren't wrong to not invest in this thing that was potentially speculative, had very bad press, very large drawdowns. It was prudent. I think now it's gone the other way. So, now if you are looking to diversify, we are heading into an inflationary environment. There's, that I don't think is, I think that is certain to say, right? The response to COVID was to print a third of all the money that's ever existed. And that was, that was a relatively short temper tantrum from the market in the grand scheme of things, right? Once we start getting, let's say, a year or two's drawdown in the stock market, that's 50-60%, right? And these things have happened before. What's going to be their response at that point?
Isn't it? That's the thing. So that'll be measured in dollars or pounds or euros.
But I just mean, the government response to that is going to be print and print. Right? They're going to print money on a scale that makes 2008 look like a cakewalk. Right? I seem to remember, I have the figure in my head for the 2008 crash. They borrowed 600 billion.
Yeah, it was TARP, wasn't it? Was it TARP? I mean, 600, 800 billion. We may be talking about slightly different things,
right.
but that just seems like peanuts now, doesn't it?
Right, and it seemed like an awful lot of money at the time.
Yeah.
We added 1.2 trillion in debt between the beginning of June and the beginning of September. So in 2 months, we added 1.2 trillion debt. So essentially, I don't know if I'm equating this correctly, but the debt they printed to get us out of the 2008 financial crisis, they just borrowed twice as much of that in 2 months.
No one seems to have noticed.
And no one cares. And because we're seeing the markets go up. But, anyway, look, Sam, we're going to have to do a part 2, please. I'm going to have to invite you back. This conversation has been incredible. And I think there's so much more that we can touch on. I really wanted to dive more into that stuff. And so let's do it. Let's actually come back for a part 2.
Okay. Yeah.
But to close this one out, what's one positive thing that Bitcoin has brought to your life outside of number go up?
Yes, you posed this question to me before this podcast, and I was like, oh yes, that's a really good question. I don't think I've been asked that question before, and I thought about it for a few moments, and I realised that it's actually the people I've met and the friends I've made along the way, who I never would have met in a different line, or excluding Bitcoin. And one of the great things about meeting up with other Bitcoiners is that you've got a head start in terms of a similar, not the same, but a similar sort of mindset on a lot of things. Now, sometimes that gets the accusation that it's an echo chamber, and maybe there's parts of that, but it makes a conversation a hell of a lot easier if you start off roughly in the same direction, and then you can you've got a head start and you can explore other interesting topics or nuances and so on. So that's what I would say. It's the people I've met along the way.
That's beautiful. Thank you, Sam.